Hey everybody, welcome to the morning market briefing Thursday, May 12th, 2022. Hope you're doing well. A little choppiness here in the market. So we're going to be talking about some of that volatility. Let's start off with interest rates, Tom. We've talked a lot about equities. We've talked a lot about, Fed action, but what are we actually seeing on interest rates as it relates to actual demand for paper?
So yesterday was really a mixed bag. So as soon as the CPI number came out, we saw red across the board, pretty much at every stop along the yield curve. And then, call it about halfway through the day as the markets really were coming down, we saw a ton of money flow into treasuries. We had a pretty lackluster 10-year auction at 1 o'clock where there's a bit of a tail. 70% of the bonds were sold overseas, so there wasn't a ton of demand internally, or at least domestically. And that was right at about 294 on the 10-year. And then from that point forward, we've just seen, unstoppable buying across the yield curve. So the 2-year dropped all the way down to about a 255. The 10-year has dropped all the way to a 282. We were at 315 at the beginning of the week. Which is a massive move for the 10-year to the downside, which is good news. What we've seen this year is just 100% correlation. Stocks are down, bonds are down, stocks are down 10%, bonds are down 10%. If you've got a 60-40 portfolio, there really hasn't been that safety aspect in the bond portfolio, but we're seeing that today. We're seeing just a massive retracement in bonds, and we're not seeing extraordinary flattening. We have flattened a bit. We're down to about 25 basis points spread between the 2-year and the 10-year, but proportionally, that's probably about in line with where we were before. The concern now is that if the Fed really gets aggressive to fight CPI, which was elevated yesterday, then, the further down we go in terms of demand across the board, the more likely we are to invert again, just as a function of the short end getting pushed up. But for now, we should see in the next 24 to 48 hours, some repricing on individual bonds and portfolios that's going to be the upside. And that is going to help overall portfolio performance quite a bit. As we've seen just really, really, really rough markets in the bond market to start the year. The roughest I've ever seen in my career, and perhaps the most rough since 1977 is as far back as I've gone looking for a start as bad as it has been for the year. But we're seeing some relief there finally. So that's very positive in my mind, just to see, a little bit of a traditional flight to safety. The markets are coming down. People are flooding into bonds to try and have a little bit of a safety net. And so that's very beneficial for us on the portfolio side. However, equity markets were a little bit of a different story yesterday.
Yeah, Tom, one thing I wanted to ask you about, you mentioned the inversion. We talked a decent amount about inversions and what that may mean for recessions. We're talking a lot about recessions right now. We had the inversion not that long ago. If we get another inversion, what's kind of the market narrative? What's going to be the headline on the Wall Street Journal, given that we've already had one inversion that would probably be correlated to quote unquote this recession?
Well, it's kind of hard to say because the inversion that we got, assuming that we have a negative GDP print for the second quarter, we already had one for the first quarter. So we would have inverted at the same time as the recession began, which would kind of take that data point off the inversions equal recessions, because that one would have been simultaneous. So I think, it might actually pull apart that theory a little bit. We've done a little bit of analysis showing that it really doesn't, it's not an exact predictor. It's really more of a tall tale. We talked about that in the macro, but I think you'll see it creep back in. They'll say, oh, well, that other one is it's just another inversion that's going to our next recession. But it's possible that we're already there. And so I think, that's going to be the headline at first. But I think that it's not going to play that out that way. Cause I think it's a very high probability, over 50%, that we're probably in a short but sweet recession right now.
Markets continuing to see volatility across the board, as Tom alluded to. Even right now, futures markets on the S&P down close to 1%, Dow futures down about 0.2%, NASDAQ futures down close to 1.5%. Obviously, choppy day yesterday. Lots of economic data going through. I think people are trying to kind of figure out where they are. Bitcoin just continually taking it on the chin, fell down into the $25,000 range, which would be, close to 65% off the 12-month high. Right now it's trading at 27,000. Ben, what turns the Bitcoin narrative around? Like, give me devil's advocate here on Bitcoin. I know the three of us have been out on it, and we finally look like maybe we were right.
I mean, price is a great equalizer. So price comes down, demand should go up for it, theoretically. But I don't think you hit that until it certainly goes below 10,000. If I was to say what's the positive spin on this now, I think that you're probably looking for a short-term rebound. I don't think you're looking for something that's a little bit more meaningful. And it could be a short-term rebound. I mean, I do think that we're seeing a lot of liquidations. I think that we're seeing a lot of panic, a lot of new money that all of a sudden became very, very wealthy overnight. They're going to want to lock in a lot of that stuff at this point. I think that as you go down further, as we fall from 50,000 to 40,000, they say we've seen this move before. When you go from 40,000 to 30,000, they say, man, this is it. This is when you kind of load the boat. When you go to 30,000 to 20,000, that's when you start to see the liquidations and say, you know what, I can't take this anymore. I have to get out because now my financial well-being is being put in jeopardy. And I think that's what you're seeing with Bitcoin.
Yeah, and it seems like that phase could accelerate.
It could accelerate. It could be a little bit of capitulation you see now, and then maybe you have a little bit of a bounce. And it's a very, very difficult time, and no one wants to catch that falling knife. So if you're bold enough, you could make a little bit of money maybe, but I wouldn't be that bold.
Yeah, we've kind of stayed away.
Yeah, if anything, now is the time to buy Beanie Babies.
Sports cards.
Basically the same concept.
We're starting to see some new layoffs, some interesting data. We did get initial jobless claims data coming through today. It was up 1,000 from where it was last week. So we're at 203,000 initial jobless claims. But been some interesting data kind of parsing through anecdotes of people, kind of right sizing their company to an extent. We've got Facebook that's slowing on the hiring. Uber has announced that they're making hiring a privilege. Robinhood, this is probably not a surprise and maybe not as much of an indicator on the broader economy, but laying off 9% of its full-time employees. Carvana's laying people off. How are you kind of looking at these layoffs as you're building kind of your web of the overall economy in addition to data like initial jobless claims?
I think so far a lot of the positivity around markets has been around the idea that the unemployment rate is low and employment is high, and in fact we need more workers, not fewer workers. But I think we're beginning to see a bit of a shift there, and these things can happen quickly. It's a lot easier to go up fast in the unemployment rate than down fast in the unemployment rate. And that would be my concern from here on over the next number of months, is that we will start to see an increase in layoffs and an increase in the unemployment rate. And frankly, the Federal Reserve kind of wants that. They want the unemployment rate to go up because right now we have too many people. It's pushing up inflation, and it is at risk of creating that wage spiral. So the Carvana one is really interesting there because that's a real company. They have a real business. They're laying off 2,500 employees. This is a company that only has 10,000 employees. They're laying off 25% of the workforce. And executives are going to go not just a pay freeze, they're going to go unpaid for the remainder of 2022. So a lot of this is actually having real consequences in the real economy. Right now, a lot of it's concentrated on Silicon Valley, but my concern would be that metastasizes to other parts of the economy. I think that there is less contagion risk than if you're actually infected in the financial system itself. I think there's less contagion risk when it's kind of the technology sector or Bitcoin or things like this. Having said that, it's difficult to predict contagion before it actually happens.
Yeah.
And so that's something that we have to be mindful of. But there's actually a website that I found this morning called layoffs.fyi, just layoffs.fyi. And it shows, and it's focused on startups, technology companies, especially in Silicon Valley. And we are beginning to see some tick ups in new employees laid off. And in fact, the month of May, we're already higher than we were in April, and we're already almost as high as we were in March in terms of layoffs. and we're not even halfway through the month. So I do think that we're beginning to see some impact on layoffs. Again, right now, mostly on the tech side, but am concerned that could metastasize.
Disney reported earnings. They're down about 4.5%, trading right around $100. It's a stock that's been in the high 180s within the last 12 months. Some of those numbers are going to start to feel a little bit numb as we make these comments. I mean, the whole market's down a ton, so take that with a grain of salt. Ben, Disney's been in the news a lot. What would you say to someone that says, "Hey, this is because of the political aspects of the company"? This was, they've been in the headlines for all the wrong reasons. And now the stock's getting punished. Do you think that's an accurate narrative, or is there something else going on?
I don't think that's an accurate narrative. I think the narrative, I mean, and the reason I don't think that's the case is because they have tons of demand for the parks. Their per capita prices on the parks are up 20% from last year, up 40% from 2019. So they're able to attract people to such an extent that they can raise prices very aggressively. So they're actually seeing more and accelerated subscribers to their Disney Plus offering. I think the concern with Disney is much more about management and less about management's political beliefs and more about management's ability to actually govern a business and run a cohesive strategy. I think that they are increasingly reliant on Disney Plus, and everything runs through Disney Plus. New content runs through Disney Plus. New revenue models run through Disney Plus. They're going to launch an ad-supported Disney Plus at the end of the year. And my concern is that, are they asking this app to do too much? And I think that that's the concern from a lot of management. And you can see it in the stock price. The stock price was up 3.5% after it reported the numbers. And then by the time the conference call was over, the stock was down 5%. There was a 9% round trip because I think management lacks strategy. And I don't think the analysts are really keen on this, because the analysts all went to the same schools. They all have the MBA. They all like the data science. They all like the modeling. But the problem is MBA data analysts do not model inflection points. You model trends. And when the trend is moving in the right direction, you can model sales and you can model where you should be pricing and all of this, and where you can model volume, but you can't model when things change, and you can't figure out what those inflection points are. And I think that's the big concern for Disney, is that they're too reliant on kind of these projects, and they don't have a cohesive strategy other than go through Disney Plus.
I mean, I think it's almost like they thought, they saw the writing on the wall. They saw they were getting edged out by Netflix. So they went straight to Netflix. But the problem is Netflix has a number of flaws as well. And now Disney Plus is realizing, oh man, we might have those same flaws. And it's become a little bit of a drag rather than a growth aspect.
I think in business, especially big business, especially when you have a bunch of consultants, is that there's this need for complexity. And I think that Disney right now has a need for simplicity. And I think that originally Disney Plus was a relatively simple product.
Very simple.
And I think that was part of its appeal. And that's why so many people were excited about that one show that came out, or The Mandalorian that came out. Now it's random shows all over the place, none of which are really that compelling. Obi-Wan launches in a month, at the end of this month. So we'll see what happens with that. But they need some home runs here, and they need to make it matter.
I mean, I wonder too, I mean, we haven't talked about this, but just thematically, I mean, you think of the struggles of Netflix, you think of the struggles with Disney. I mean, I just wonder at what point are people just oversaturated with content, even original content. I mean, I think if there was one area that, COVID kind of forced, it's, my wife and I watched a number of shows that we can't even remember the title of during the COVID period, where we couldn't really go out and do a whole lot. And it was just kind of like we had to. But in doing so, it's like the bar's kind of like the frequency with which we start a show and watch an episode or two, and then are like, that's stupid, we're out, is pretty high. And I think just even in our household, it's like there's a bit of burnout. And I think that's going to be a struggle for people that are completely reliant on subscription-based content delivery. I think that's going to be hard. PPI came through today, looking for a month-over-month change of 0.5%. Year over year expectation is 10.7. If we exclude food and energy, looking for a month over month estimate increase of 0.6 year over year, 8.9. Ben, how do we do? Tom, how do we do?
So interesting here. So we did come in hot. So it came in at 11%, which is only a drop of 20 basis points. And so the expectation was 0.5%. But what they did is they actually revised up last month to 11.5%. So in theory, we came in right in line with the expectation of the drop in terms of the percentage change from going from 11.5 to 11. But that's because they revised last month up. So it was even worse last month than before. Ex food and energy, they revised up to 9.6 from 9.2. We came in slightly under there, 8.8 versus an expectation of 8.9. The acceleration seems to be in ex food, ex energy, and trade, which was up to 6.9%. So it was only down 0.1%, versus an expectation of 0.4. So it's kind of a mixed bag here. I think the market, at least as far as I can tell on the bond side, is reading this as coming in line because of the adjustments. We're not seeing a lot of movement there, at least not at the moment. Bonds continue to be rallying pretty hard. So I think yesterday was the big number. I think this one is sort of, because yesterday came in so hot on CPI and this one is kind of in line, I would say that it's not shocking anybody. It's not coming in lower and it's not really making anyone excited either. It's just kind of an inline number, despite the fact that it's off a little bit. I think the revisions really play into that, at least at first glance.
Yeah, I mean, we're certainly seeing different behavior even on the equity side in terms of what's going on. I mean, yesterday when we got the CPI number, futures fell off a cliff. They're basically hanging where they were at 8 a.m. So relatively stable there. Ben, any takeaways on PPI?
Yeah, I mean, just echoing Tom. I mean, it seems the numbers were, pretty much in line, I would say. And then but I like you say, the CPI was the one that really is the important one. That's the one the Fed watches, and based on the glacial decline there, and frankly, the glacial decline we're seeing in PPI, we kind of know the story, and this is going to take a long time to come down if we continue at these rates, which means Federal Reserve is going to continue to hike, and it's going to be more persistent for longer.
Yep. We'll wrap it up there. We'll be back tomorrow. Tomorrow we probably will be Zooming from like a vehicle somewhere. The three of us are going to a meeting. So we will miss producer Logan dearly, but we will do the call at 8:30. It might be rough, but we'll do what we can. Maybe from Buc-ee's. We'll see.
Ooh,
that'd be pretty cool.
Leeds, Alabama.
Yep.
Let's go.
Hope you guys have a great day, and we'll talk to you guys in about 24 hours.